Hello, YouTube. We're going to talk about a crash warning for the stock market because it usually takes the staircase up and the elevator down. We are starting to see some warning signs on QQQ and SPY that we could be heading lower. And this weekend's update is going to talk about a note from Bank of America where they tell us that the S&P could hit 3,800 in the next 7 weeks or take the elevator down and drop roughly 7%. So we're going to go through a couple of charts at a high level to explain what's happening, but please make sure to stay tuned all the way till the end of the video if you want all the context, because I think this week brings a lot of potential. We're looking here at a bearish pattern on QQQ, which is our head and shoulders on the 1 month chart. Why is this important? Well, because it's still over that 50 monthly moving average, but S&P is not. It has now had a failed breakout, which means it got above the area from last month at 408, 409, but failed to hold it. That is the first warning sign. And we note that if we're going to come all the way down with the bear market thesis we talked about last weekend, where can we hit? I'm looking for about 378, which would be roughly 380, or that Bank of America note here at about 3,800. The other reason why we want to be mindful of this is because Wall Street is baffled by the stock market. How are they baffled? Well, the bond market finally got the Fed's message on rates, while stock investors continue to ignore it for the most part. So now that OPEX is over, we want to understand what exactly are these guys talking about, because I think there is a lot of complacency currently being baked in. And if I look here to our weekly chart, here's what it really comes down to. I have two boxes highlighted here. The box at the bottom where we basically formed our bottom and started going higher versus the move up here for the last 3 weeks where we have wicks. So at the bottom, let's delete everything now and make it really simple. We're going to zoom in and see if we can understand what is happening technically here, because fundamentally, these guys are telling us we're going to go down. So we have three nice lower wicks at the bottom, which leads to a nice rally. We now have the opposite happening here, where we have three upper wicks. And the difference here is that if we flip the chart upside down, we confirmed we were going to be going higher when we took out the 2 monthly weekly highs. What have we not done yet here? Well, we've not taken out last week's low and held it. That's a failed breakdown. And we also have to get a below 400.28 or lose our 50 weekly moving average and print a new low of the month. So if we're going to be printing a new low of the month, currently at 402, that could be what starts the move lower all the way back down to 380. I'm going to show you two more quick charts, or maybe a few more quick charts, just to provide a little bit of context, because if we look here to our heat map so far this year, we note that healthcare is not doing so hot, energy is not doing hot, but technology is doing hot. Financials are kind of mixed. So let's look through a couple more charts to see if there is context so we can understand that the S&P 500 includes 500 stocks. And if we look here to something like the RSP or equal weight S&P 500, what do we have? Failed breakout on the monthly. We look to the Dow. That's a failed breakout by a few cents here on the monthly, forming a flag. We look to New York Stock Exchange or 2,000 stocks. It is a failed breakout. The Russell has a breakout or is above that area. We jump down to SMH or SOX, and we note that it's also in a breakout above the previous monthly candle. We look to ARC, also above. XLV. This is where we're not actually going higher anymore. We now have 2 months with lower highs and 2 months with lower lows. Same thing with XLF here, where we have that monthly failed breakout. So the ones that are really missing are the Russell, chips, and then also technology. If we look to the rest of the world, the DAX still has a monthly breakout, pretty close to all-time highs, right? It's not that far off from it, maybe 5% off, versus emerging markets with what? An inside bar down 4% for emerging markets, and then FXI is currently down by about 7% so far this month. So I believe the stage is set, and now we're going to go through and tell you a little bit of a story with some charts, and then we're going to come back and leave you with an actionable plan for the rest of the week. And if you're bullish, please just note that I've been going over the bullish scenario for the last couple of weeks, last couple of months. Yesterday, we talked about how a big move was going to be coming, meaning we were looking at QQQ and how we were at a turning point. And right now, we actually closed green on QQQ. So what I'm trying to do right now is to give you a warning before we maybe go lower. Why? We want to buy insurance or be prepared before something bad happens. So I'm not calling for this to be the base case. I'm just calling for this to be the most important thing for us to be watching right now, because we're getting evidence that QQQ has not actually completed a monthly failed breakout yet, but with the headlines we have this week, I could definitely see it happening. And the S&P has already confirmed it because it is back below last month's high at 408.16. It's only off by about $1, so we could definitely punch back over. But if we don't, let's just remember that if we're remaining bullish, we could potentially lose, or the risk we're putting on is $1 versus the $3 we could lose. We can make one, but we can lose three if we're below 409. That's why it's so important. So again, please make sure to stay tuned all the way till the end of the video if you want to get all of that insight. If you're enjoying the video, please consider smashing the thumbs up and subscribing to the channel. I would greatly appreciate it. We talked about the year-to-date heat map so far. Let's move forward. So Bank of America and Goldman Sachs are both calling for extending rate hikes into June. What does that mean? It means that when we look here to their 2023 calendar, they're going to be hiking for March, May, and June. Note the asterisk is that means a meeting associated with the Summary of Economic Projections, or the SEP, which we'll touch on a little bit later. Another thing which is particularly interesting is just that ever since December 26th, there was three readings where people, meaning retail, wanted the market to go higher. Well, ever since then, January 16th, down, 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 down. Retail seems to want this move so badly. So this is the update for you. Here we go. The key dates for this week for me are going to be Wednesday and then Friday. So the reason why the Wednesday meeting is going to be so important is because we're going to be getting FOMC meeting minutes. And then on Friday, we're going to be getting core PCE, or the Fed's favorite inflation gauge. In addition to that, we're also going to have Russia calling a UN Security Council meeting on February 22nd, which just adds to the potential volatility which could happen on Wednesday. Remember, if Friday is the weekly close of the week, and that is where we have the most important data point, what could that mean? It could mean that we're either going to be doing well on a weekly close, meaning we're going to be bull breaking, getting above our 20% bull market area at about 417, 418, or we're going to start to fizzle. And this monthly failed breakout is going to turn into a nasty candle where it's going to start shooting lower. So with those dates in mind and the potential for Russia, let's see if we can learn anything from them. 1 year on, Putin must have wished he'd read his Herodotus. I'm pretty sure that's a Greek philosopher. Blah, 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 blah. He has been arrogantly wrong about almost everything. Is the Fed potentially going to make the same mistakes? This inflation report will lead to bad Fed decisions. What are those bad Fed decisions? Let's just read it here really fast. Blah, 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 blah. Consumers aren't as worried as the Fed thinks. Household outlook for inflation over the 3 months has collapsed to the lowest level since 2020. So the Fed keeps hiking, as those two banks just outlined. They might be doing too much. We're going to go through a couple of headlines from this week now to try to get some context. We're just going to read the headlines. This is James Bullard. Doesn't vote this year, but let's read the headlines. U.S. rates may be headed higher than Wall Street or Fed think. All right. U.S. inflation stays elevated, adding pressure for more Fed hikes. Okay. Bird flu sent egg prices surging. Chicken prices may be next. So that's your CPI. That's what could continue to drive it higher. On the flip side, we also have the Department of Energy can now buy oil futures for future delivery at a fixed price, the administration announced. Between what? Between 67 and 72, or providing a floor to oil prices, which could cause another bout of volatility. They're going to be buying all the way through to 2023. Bond market keeps inflation expectations elevated after CPI print. We just alluded to that. What does it mean? It means that the Fed funds rate outlook has now been increased to 5.29 going into August of 2023, and then 5.2 into October, and then down to 5 for January of 2024, which means we're actually pricing in more rate hikes, and we're not really pricing in any cuts until next year. That's basically flat. That happened in the course of 2 weeks. So note here again, because we're going to be getting those meeting minutes out here on Wednesday, we're going to be getting a backwards looking statement. So look at these next couple of headlines here. I think they'll be really important for you. So Fed's Bullard open to half-point hike at the next meeting. Official seeks Fed funds rate at 5.37 as soon as possible. That's much closer to where the bond market's already priced in. Inflation boogeyman now hides in services. That's going to be PCE, and we will circle back and talk about that in a few minutes here. All right, Biden says there's work to do on inflation as data is stubbornly high. Even Biden's saying it. He's not taking a victory lap right now. There's also concerns about household debt hitting record levels, 16.9 trillion, as consumers load up on credit card debt. That is not the sign of a healthy economy when people are loading up on credit debt. Larry Summers also says the Fed's brakes are not getting too much traction on inflation, which means what? Maybe they got to go even higher. There we go. Moving forward, Fed's Bullard open to half-point hike in next meeting. I think we just talked about that one. And then Fed's Mesters says she saw compelling case for half-point hike when? At the last meeting. So if there's going to be a repricing, I think that could happen on Wednesday where we reset expectations. And then on Friday, it's going to be determined where I think this number is going to be bearish. I'll talk about that a little bit later. Fed's Bullard warns U.S. risks repeating in the 1970s inflation. So the Fed is so dead set on the past, they might create a new kind of problem into the future. Fed swaps price in full 25 basis point rate hikes in March and May, but it has not yet done it for June. That's the wild card. All right, as we move forward now, the Fed's preferred inflation gauge, or PCE, is seen running hot. We're going to provide some supporting evidence for this too now. So the Fed's preferred inflation gauge, or core PCE, on a month-over-month is going to be seen accelerating. We're going to read a couple of quotes here. It's stunning the decline in year-over-year inflation is stalled completely, given the favorable base effects and supply environment. That means it won't take much for new inflation peaks to arise. Oh no. The Fed has 3 goals for this year: moderation in good prices, or CPI, moderation in services prices, excluding housing, or PCE, and then more slack in the labor market. They have 1 out of 3 so far. This is also a note that I had prepared here on December 24th. So I'm really just circling back on previous content we laid out. And now with that technical reason as to why we want to be mindful, basically looking here at our box where we have our lower wicks and our box where we have these upper wicks. We're also battling with key levels, meaning Fibonacci levels. So we stalled out at 414, and that 398 area we just alluded to on the monthly as well is the 0.38 retracement here. Math. We talked about this before as well. So again, Larry Summers says the Fed's brakes are not getting very much traction on inflation. With a quote we just read, that should cause some concern. We're now going to jump into the summary of economic projections from the last meeting, September 21st, and try to get a little bit of context in terms of what that reading needs to look like going into Friday for us to truly get the move we need for a sustained move higher. So here we're looking at core PCE, and we're looking here at the fact that we got a peak in October and it's now coming down. You can note all the previous numbers here. I've compiled those into a cheat sheet here. So you buy insurance when you don't need it, not when you do. Again, going back to me getting prepared going into this year in late December. Options going back into late December were the Fed blinks, and that can only happen on the SEP. Why? They have to justify why they're making a change in policy. So that could have happened in March or June, and now it looks like it's going to be June. Fed blinks, or sorry, the market blinks. 2s and 10s start climbing. That could be any time. Well, let's have a quick look at the 2 and 10-year note. Why? Because they've been booming so far this year. We look at the 2-year note here. It's up by 10% on the month. Bullish engulfing candle. We look at the 10-year note. Bullish engulfing candle, but not quite at last month's high. It's up by 9% on the month. Whoa! Right? So it looks like the market blinked, meaning the bond market. What is missing? The stock market. The stock market is shrugging it. It is fighting it. And I think there could be some elevator down if after OPEX, we're now going to truly be going lower. The Fed has also said that they want a 3 month of trends to constitute, 3 months of trending down to constitute a trend. That's the reason why Jerome started using that word disinflation. Why? Well, because for 3 months, we now saw that inflation was coming down for 3 months. So disinflation has started, but it is not done. So if we understand what the Fed is telling us and we look at the data, it should be like really easy. The Fed wants to see the Fed funds rate 1.5% above the PCE rate, the core PCE, for it to be sufficiently restrictive, for the threshold to be met. And until that happens, they're probably going to have to hold higher for longer. And we already told you that the 2023 Fed funds future outlook is now priced that in. So the bond market came right to the Fed, and it happened pretty fast. On January 18th to February 14th, or just over 1 month, we had 4.34 versus 5. So the market came to the Fed. The only one missing now is the stock market. So we looked at those core PCE numbers before. And what I did is actually compile them into a little math formula here just for time on the video. And if you're enjoying the video at any time, I would really appreciate if you could smash that thumbs up and please consider subscribing to the channel. It would mean a lot to me personally, and I'll be providing updates all week on what we just laid out. So if we look here to the most recent numbers, 5.25, 4.7, 4.4, I put the rate of deflation, and then I extrapolate that out, put the 2% for the last one, and then the projection coming in on Friday. So what that means is that we can find out the average by taking them all and then dividing by 5, which gives us an average deflation of 4%. So to average the Fed's target, we need 3.1 for the entire year, and we need an average of 3.5% deflation. If this confuses you, all it means is that I'm trying to find out what the Fed told us they want at the end of 2023 for core PCE, which is 3.1, and where the Fed funds rate could be for that to happen. Then I did the math for you, so it's nice and simple. We have 4% starting this year. We're going to be compounding for 12 periods at a 3.5% decline or deflation, and that gives us a future rate, or in 12 months, at 3.06. That's how we get here to the 3.1 by the end of the year. The problem is that right now we're seeing inflation going, so 4.66, that's above the 3.5 we need. But now for the last month and for this current month, it's down to 2. It's not enough. We're not going to make it. So if we're not going to make it, that's how the market could reprice. It could happen fast. It could happen dirty. And that's how we get an elevator down. Continuing here. 4% inflation on a trailing 5-month basis. We're over the 3.5% required. The problem is that the 2% on a trailing 2-month basis, we're off by nearly 50%. There's easy come, easy go inflation versus harder come, harder go inflation. Here's the takeaways. If we start getting readings that are showing a slowdown in the rate of deflation, they will have to adjust the SEP in either March or June. March is the next meeting. June is when we expect a pause in rates now. The SEP will have to back up a pause and or a pivot. To hit their 2024 goal, they need to see a target of 2.3%. Again, going back here to the SEP, we're looking at this number right here, the 2.3 for 2024. The only way that happens is if we take our 4.7% starting rate from this year and we compound for 24 periods at a deflationary rate of 3%. That's how we get to 2.26, which is what? Basically the 2.3 they've laid out here. So we have to be in deflationary year over year at 3%. That 2% we're going to get for this next reading is not enough. And that is how I could see every pricing happening. Again, one more time. The Fed's preferred inflation gauge. It's not CPI. What is it? It's PCE. Let's read this quote one more time. It's stunning that the decline in year-over-year inflation has stalled completely, given the favorable base effects and supply environment. That means it won't take much for new inflation peaks to arise. Inflations have been upping their bets on how far the Fed will have to raise rates, blah, 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 now climbing to 5.3, as we just reviewed in that last screenshot. So it really comes down to the SEP, which we've been talking about, or where there is a meeting with an asterisk that happens in March, June, September, and December. So I don't think we're going to get a pause now. Why? We're expecting hikes for March and May. We're not sure about June yet. It's not been priced in, but it's looking like it might be more and more likely. Here's someone who's smarter than me too. His name's Mohammed Al-Arian, and Fed can't reach 2% inflation target without crushing the economy. So there's going to be a trade-off. Are they going to crush the market? Are they going to conquer inflation? And I know we haven't talked about this one in a bit here, but what's really important to understand is that the majority of the decline in these bear markets occurred after the Fed pivot. Why? The Fed usually breaks. They keep hiking until something breaks. And then when something breaks, they come in and start cutting. So a pause is one thing. A pivot is something else. If we actually see a pivot, no one wants that. A pivot means that something is fundamentally wrong with either the economy, with the market, or there's systemic risk or something else. They're not going to do it otherwise. They are dead set on their mandate. And the takeaway I wanted you to be left with was that it is very important that if you've done well or not done well so far this year, that if we are going to be going lower and the risk reward is now skewed 1 to 3, be very mindful that it takes more and more money to make it back, which means if you don't know what's going to happen, sit on the sidelines. And if you have a plan and you understand the risk, then just trade it out. Otherwise, pause the slide, watch these numbers, and see that this could be a little bit scary. If you've enjoyed this video, I would really appreciate if you could smash a thumbs up. And if not, I really look forward to seeing you on the videos for the rest of the week. Thank you so much for watching.